Starbucks reported earnings and the stock is down over 11.5% in the after hours. Now, I know this video is going to be going up on Wednesday and I'm not sure what kind of price Starbucks will open at, but everything in this video is based off a $78 price. So as long as Starbucks is anywhere close to $78, this video is valid for the calculations. In this video, I'm going to update you on the earnings of Starbucks, update you on my valuation model, which has of course changed from the recent guidance, which has been very, very bad. I'm going to talk about Starbucks' financial position and why it's in a very bad position in terms of buying back stock and many different things. I think it's going to be a very insightful video and I really hope you enjoy it. Now, for Starbucks, earnings were absolutely horrible. I just have to say the truth. 68 cents versus 79 cents expected. Massive miss on earnings per share. Revenues, they also missed. I mean, this is just extremely, extremely bad. Comp sales were very bad. They declined global 4%. North America, they declined 3%. In China, they declined pretty close to 11% in China and 6% international, including Europe and many different places. So this is very, very bad. One of the worst earnings I've seen for Starbucks. And of course, it's going to change my valuation model and many different things with the company. But if you look at what the management says, nothing is really encouraging me that they are trying to do the right thing. Now, this is what the management said. It says, in a highly challenged environment, this quarter results does not reflect the power of our brand, our capabilities, or the opportunities ahead. It did not meet our expectations, but we understand the specific challenges and opportunities, immediately in front of us. Now, that doesn't tell me anything. It's not telling me why Starbucks is facing such a decline. It's not telling me what is the CEO going to do to fix these things. He's talking about synergies and other things, but this is really, really bad. And I expected a better or more clarifying statement from the CEO, but we didn't get it in the earnings report. We got some more insights on the earnings call, but nothing much in the earnings report. And this is nothing that's encouraging me to be bullish on Starbucks in terms of the CEO's plan to do something about this massive decline. In fact, they expect the decline to continue over the next 3 to 4 quarters. They expect an improvement in the fourth quarter of 2024. And no one really knows what's going to happen in October, November, December. A lot of people, especially on Twitter, they're talking about this chart of cocoa, that cocoa prices are causing, coffee prices are causing, margins to compress. This is somewhat true. Cocoa prices have skyrocketed and they're starting to decline. But most of the issue is not much about expenses. Yes, expenses, of course, do matter, but it's just mainly about top line. I mean, company-operated stores in terms of revenues, even total revenue declined. Starbucks used to grow revenues 8, 9, 10%, earnings per share 15, 20%, 22% earnings per share. It's nowhere close to that. Top line is declining without even cocoa affecting things. Top line is declining. And it's really, really bad. But it's not the only one. We saw the same thing from Pepsi and Coke. Even though they have much better pricing powers, they can pass on the cost. Starbucks has some kind of pricing power, but not as good as Pepsi and Coca-Cola, of course. But, McDonald's is suffering. Ulta Beauty is suffering. Gucci is suffering. A lot of better brands are suffering. So most retailers are suffering right now. This is not just a Starbucks thing. But it's easier to cut on Starbucks than to cut on other things, getting a cheaper coffee, for example, or something else that you like if you're really tight financially. It makes a lot of sense. And this is one of the reasons why Starbucks is suffering and is expected to continue to suffer with a very bad guidance. Global, low single-digit decline to flat. US low single-digit decline to flat in terms of comp sales. China single-digit decline. China was one of the best growing areas for them. And now the tide is shifting and China is expected to decline in 2024 in terms of comp sales. It's really bad stuff. Global revenues, low single-digit increase. I used flat revenue growth. CapEx, $3 billion, much higher than last year. I'm not happy with that stuff. Earnings per share, flat to low single digits. I would say most likely flat. Now, whenever I see such earnings report, whenever I see such a chart of a stock going down right now, but it also has been going down over 22%, with the earnings report, it's down like 35%. Over the last year. Whenever I see such charts, the first question I ask myself, is the company in a good position to buy back stock and create long-term shareholder value? Because this is the best thing this company can do if the stock price is low, if the stock price is undervalued, if the multiple got contracted. The best thing Starbucks can do is buy back stock at very low prices and create massive value for long-term investors. So the first question I ask myself, is Starbucks in a good position to buy back stock and take advantage of these prices, or is Starbucks over leveraged and they cannot really afford to do buybacks? I'm going to give you the answer right now. Now, for cash from operations, it was expected to be amazing for 2024, but revenues and net income are likely going to be the same with the current guidance. So I would take the cash from operations of 2023, which was pretty close to $6 billion. Now, taking $6 billion, if you remember from the guidance, we got $3 billion in CapEx, which would lead us to free cash flow of around $3 billion. Not bad for an $88 billion company using the $78 price. But $3 billion of free cash flow, the company has a dividend obligation of $2.4 billion. So this would leave us with $600 million of free cash flow. But the company also has some debt obligations. I'm going to zoom in a little bit so I could show you. But for 2024, the company has around $1.2 billion of debt due. They only have $600 million of free cash flow. So they need to take $600 million out of the cash position, and they only have $2.7 billion of cash. So if they really want to do any significant buybacks, Starbucks has to most likely borrow money on high interest rates to buy back stock if they really wanted to. And if they do that, it will help create some value. But at the same time, they're going to be paying much higher interest rates. So unfortunately, Starbucks is not in a good position to buy back stock. I wish it was. Maybe Ulta Beauty, I talked about this stock. It's another one that's suffering as a retailer, but they have amazing free cash flow, amazing balance sheet, and no debt. Meta is also in an amazing position to buy back stock from the free cash flow and the good balance sheet. But Starbucks, with the debt obligations and everything they have, Starbucks is not in a good position to take advantage of this dip, to take advantage of these low prices to create shareholder value. Yes, maybe they might end up borrowing money and doing it. I would not be surprised, but it will still gonna cost much more interest, and it's not gonna be the best value creations for shareholder if Starbucks was a little bit more disciplined. I'm not saying the dividend is gonna be cut. I think the dividend is safe. I think the debt is safe with Starbucks. They can pay it off easily or maybe refinance it to another date, but still they're not in a very good position to buy back stock. And this is my valuation model on Starbucks, but before I get into it, I know the number one comment I'm gonna get is that I lowered my fair value because Starbucks stock went down. Not because the stock went down, but because the fundamentals got worse. If the fundamentals get worse, my thesis is not going to remain the same. And I don't know why people cannot understand it. They always tell me, oh, you lowered your fair value because you're scared of looking wrong, because the stock went down. No, because earnings were worse. If the stock went up, but earnings were very, very bad, I'm still going to lower my fair value. If the stock has no relation, I look at the value. I don't look at the price. But for the value, I have to lower it because the whole thesis has changed, and this is why Starbucks is down 12%. Okay, now for 2024, I used 0% revenue growth. I had around 10 to 12% before, now it's 0%, and 10% between 2025 to 2028, which is their long-term guidance. It was around 10%. And even the long-term guidance, I'm not very sure of it, because for fiscal year 2024, they had 10 to 12%. Now it's pretty close to 0% or 1 or 2%. So I prefer to keep it at 0% for 2024 and long term of 10%. I think this is more fair. PE ratio is now sitting at 22 times earnings. It might be, a lot of you will not believe it, but you could take the 2023 earnings per share and you could figure it out. It's pretty close to 22 times earnings, even though the stock has declined around 12%. And the main reason for that is Starbucks is not going to grow earnings per share anymore in 2024. It's flat to single digit growth. So I rather use flat. So using flat, even after the 12% decline, Starbucks is still sitting at 22 times earnings. The mean was 28 times earnings, but it was growing much faster back then. So I would say 23 times earnings is somewhat fair for the company. I used a 3% shareholders yield, which is like a 2.8% dividend and some buybacks. I think 3% is fair. In total, if you buy Starbucks today, I would expect 71% on the upside or 12.2% CAGR for the next 5 years, which is not bad at all for a lot of dividend investors, for a lot of conservative investors. But if I want to safely double my money on Starbucks over the next 5 years, I would have to buy the stock pretty close to $66 per share. And now the stock, even after the decline, is still trading at $78 per share. Now I have to say, again, at this price here, I believe it's not bad. I would not expect Starbucks to go to $66, because all these good companies, high quality companies with some kind of brands, they very rarely bottom on fair value. So we always wait for them to get to the right price. We wait for Pepsi to get to 15 times earnings. It never happens. We wait for Coke to get to some kind of multiple. It doesn't happen. We wait for Microsoft to get to a multiple. It doesn't happen. So most of these good companies, they very rarely bottom on fair value. So if my fair value is 66, I would not be surprised if Starbucks bottoms at $70, $72, $73 per share, especially as the company is not in a very good position to buy back stock and support the price somehow. So for me, my fair value is 66. It doesn't mean it's getting there. If I was a very long-term investor, I would be a buyer of Starbucks here and dollar cost average down. But as I look for 15% annual returns or pretty close to doubles every 5 years, I would not consider Starbucks under a trade at $70 per share or below. I think it would be an amazing buying opportunity. But this is just my updated valuation model based off the fundamentals that have changed and the thesis and the earnings and everything has changed. It's just my view. It wasn't financial advice, and you could make the decision for yourself. If you're more of a conservative investor, you want to wait. If you're more aggressive and you have 20, 30 year horizon and you want to buy and dollar cost average down, it's up to you. But thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.